Two guys open brokerage accounts on the same afternoon, put in the same amount of money, and never speak to each other about strategy again. 10 years later, one of them has a filing cabinet full of statements. The other has a number that just keeps climbing. One of them thinks he's found the secret to passive income. He hasn't. He's about to lose, and it's going to happen so slowly he won't notice until the math is undeniable. Here's the problem with how this debate usually gets framed. Dividend investing gets sold as the mature, responsible choice. The thing your uncle does, the thing that pays you just for holding it. Index investing gets treated like the boring default for people who don't know any better. Neither of those labels comes from actually running the numbers. So today we're running them. Let's set this up fairly. Alex and Ben are both 32. Same job title, same salary, $41,000 a year after taxes to invest. Same brokerage, same starting date. The only thing that's different is what they buy. Alex builds a dividend portfolio. He puts $350 a month into a mix of well-known dividend payers. A couple of big pharmaceutical names, a telecom stock, an energy company, and a high-yield fund he found on a forum that yields close to 6%. His blended yield lands around 4.5%. Every quarter, cash hits his account. He screenshots the deposit and sends it to his brother with a fire emoji. Ben does something that feels almost too simple to be a strategy. $350 a month into a single total market index fund. He doesn't check tickers. He doesn't know what sector allocation means. He set up the auto invest once in about 4 minutes and hasn't touched it since. At the neighborhood cookout, Alex is the one people ask questions. He talks about yield, about which companies raised their payout this year, about the check that showed up before he'd even logged in to check. Ben mostly just nods along. Nobody's ever gotten excited hearing about an index fund at a barbecue. But excitement and performance are two completely different things. And what happens over the next 3 decades is going to make that difference impossible to ignore. For the first few years, Alex genuinely looks like the smarter investor. Year 1, he collects about $400 in dividends. Year 3, it's closer to $1,400. By year 5, his account is throwing off roughly $2,600 annually, arriving in chunks he didn't have to do anything for. Ben, in that same stretch, has watched his balance grow to around $26,000, and nothing has arrived. No notification, no deposit alert, just a number that moved. Alex has receipts. Ben has a balance. On the surface, this isn't close. But here's what Alex's spreadsheet doesn't show him. Every one of those dividend payments is taxable the year it lands, whether he spends it or reinvests every cent. And that cash isn't appearing from nowhere. When a company pays a dividend, its share price drops by roughly that same amount on the payment date. A $100 stock paying a $2 dividend opens the next morning at 98. Nothing was created. Value just moved columns, and now there's a tax bill attached to it. This isn't a theory some finance YouTuber cooked up. It's been documented since the early 60s. It just never makes it into the pitch. Then there's the yield trap. A high dividend yield is often a warning sign dressed up as a reward. Companies cut dividends more often than people assume, and when they do, the stock price usually falls right alongside it. So investors lose the income and the capital at the same time. Alex's Forum recommended fund yields 6% partly because the market has already priced in some doubt about whether that payout is sustainable. There's also concentration risk nobody talks about. Dividend-heavy portfolios lean hard into utilities, energy, and telecom, and lean away from the sector that's driven most of the market's growth over the last 2 decades. Alex didn't choose to opt out of that growth. He just didn't realize that's what a high-yield strategy quietly does. And there's a psychological trap sitting underneath all of it. The dividend check feels like proof the plan is working, even when the underlying portfolio is quietly falling behind. Alex could trail the market by more than 1% a year for a decade straight and still feel like he's winning, because money keeps showing up. The cash flow becomes a distraction from the actual scoreboard. Now, to be fair, because tearing down one side without examining the other is the same trick dividend marketing pulls, index investing has real drawbacks too. There's no income stream. Ben can't fund a single expense without selling shares. And for someone who values certainty, that's a genuine trade-off. Index funds are also market cap weighted, which means a handful of massive companies make up a disproportionate slice of the fund. When that handful stumbles, the whole thing feels it. And without a dividend check landing every quarter, some investors panic and sell during downturns because there's nothing tangible reassuring them the plan is intact. Discipline that dividend investing partly builds in for free. Index investing asks you to supply yourself. Those are real costs, but notice they're shorter, more situational, and mostly behavioral, not mathematical. That's not me stacking the deck. That's just where the numbers land. By year 10, Alex's portfolio sits around $190,000. Ben's is at $210,000, a $20,000 gap that Alex doesn't notice because he's comparing his account to last year's version of itself, not to Ben's. And by that measure, things still look great. His dividend checks are bigger than ever. By year 20, Alex is around $520,000. Ben is sitting at $640,000, a $120,000 gap built from 3 small leaks, running quietly the entire time. Roughly a 1% annual return drag from underweighting growth sectors, a tax bill Alex has now paid north of $22,000 on cumulatively, and an expense ratio nearly 10 times higher than Ben's fund. None of these felt significant in any single year. Compounded across 240 months, they add up to a number Alex never saw coming because his balance kept climbing the entire time, just slower than it should have. At year 30, both of them retire at 62. Ben's index fund sits at approximately $1.82 million. Alex's dividend portfolio comes in around $1.44 million, a gap of roughly $380,000. Money Alex never knew he was leaving behind because every statement told him things were going up. It gets worse at the finish line. If Ben passes his shares on to his kids, they inherit them with a step up in cost basis. Decades of gains erased for tax purposes, meaning his heirs could sell the next day and owe essentially nothing in capital gains. Alex's portfolio has been taxed every single year of its existence. There's no equivalent reset waiting for him. So does that mean dividend stocks are pointless? No, but the honest use case is narrower than the pitch suggests. Inside a Roth IRA, the entire tax drag argument disappears because dividends in that account are never taxed. That's where dividend income actually earns its keep. And for someone already retired who genuinely values not having to decide what to sell every month, that certainty has real, non-mathematical value. The kind that keeps people from panic selling during a crash, which is worth something even if it doesn't show up in a spreadsheet. But for someone in their 20s or 30s, building wealth in a regular taxable account with decades ahead of them, the math isn't subtle. Lower fees, lower taxes, broader diversification, and a historical return advantage all point the same direction. If you're actually deciding between these two paths right now, here's the version that works for most people. Build your core wealth in low-cost, broad index funds during your accumulation years. That's where the math wins. Full stop. If dividend income genuinely appeals to you, hold it inside a Roth IRA where the tax drag vanishes. And if you're within 5 or 10 years of retirement, shifting a portion toward dividend-paying stocks for stability is a reasonable adjustment, as a complement to what you've already built, not a replacement for it. The real trap was never dividend stocks themselves. It was believing that a check landing in your account every quarter was the same thing as your money actually growing. It usually isn't. And once you see the gap in black and white, it's hard to unsee it.